Welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in. Alrighty, everyone. Welcome back to the Asset Revolution. We are recording a bonus episode this week for you all to highlight two important things. The first thing is, before we get into the topic, we have to highlight that it is a very unique time in the world right now. And we want to send our thoughts and prayers and energy out to everyone who's being affected by the invasion of Ukraine. And we really are hoping for peace and humanity to come forth in this uncertain time. And, you know, if you or anybody you know are being directly or indirectly affected, everyone from here at Arbor Digital is with you, stands with you, and please go engage, donate, do what you can to help. Every little bit counts. So with that being stated at the beginning, I do want to get in because today's bonus episode is focused on crypto taxes. We just passed our first deadline, March 15th, for some important pieces. So you're only going to start seeing that ramp up and before the big deadlines coming up in April. So we wanted to arm you with the knowledge and information needed to navigate the tax landscape. And joining me today, you know what? I'm not even going to introduce him myself. I would love, Jordan, please tell the audience about yourself so that way they can get a sense of who you are.
Yeah, of course. Thank you. My name is Jordan Bass. I'm a CPA and tax lawyer specializing in this digital asset space. I've been doing this since 2017, which seems like a long time ago. In crypto, it seems like decades ago, but it's only really been a few years. And it's been great. You know, we have a CPA firm that really helps clients from a tax perspective plan for certain digital asset sales, certain digital asset types of activity, as well as help file and prepare tax returns to assist the IRS kind of knowing what's going on so that these taxpayers can be in line and make sure that they're, you know, not doing anything that they wouldn't want to be caught up in. That's number one. But also the main part of the firm and the main focus that we have is really reconciling the crypto transactions that these individuals have for them, because oftentimes it can be a very, very laborious task for individuals or entities to do that for themselves. And that's really where the focus of the firm is. And that's really where it started, is helping people provide reconciliation reports from a tax perspective on the CPA side, making sure that everything's ready from a tax filing side of things. On the law firm side, we do a little bit of a different sort of structure, a lot of planning, a lot of structuring, working with NFT clients, working with some blockchain protocols, depending on what they need. It can be simple tax planning. It can be structuring from a corporate side of things, onshore, offshore, what makes the most sense. But ultimately, what it comes down to is similar to what the CPA side is, making sure that everyone is in regulatory compliance and making sure that there are no issues there. And that has been more recent. The law firm is only about a year old. Obviously, I became a CPA before I became a lawyer, but we do a lot of the same things in both places. And it's really just a good time being able to talk to people in this space that are doing innovative things that I couldn't think of, but I hopefully can help them with the tax side of things.
Wonderful. And there's already so many things I want to dive into, but tell us a little bit about your journey. I think another thing that I think clients really connect with is understanding how you got into crypto, your background a little bit. So please, I would love to hear how did you get into the space? Why did you decide this area?
I know, it's wild. So when I was in college, this is actually a very true story. When I was in college, not too long ago, there was somebody in one of my classes. It might have been an accounting class. I'm not sure. It might have been like a stats class. I don't really remember, but he was sitting in front of me and he was on what used to be one of these older exchanges. It might have been Mt. Gox. I don't know. This was like 2014, 2015. I think it was 2014. And he was trading things, and then he was looking up prices in like very, very small amounts, like 0.00043. Obviously, he was trading altcoins. I didn't know what he was doing. I asked him a question. He brought up Bitcoin. I had never heard of Bitcoin. Obviously, it's been a few years old. Maybe I heard it in passing, but I never took it seriously. Started to do some due diligence, started to look into this, and I thought it was fun to, buy Bitcoin and maybe trade it for these alts and try to appreciate my Bitcoin value, which is what people have been doing for many, many years since then. But I was a college student. I didn't really have much money to mess around with. I just thought it was fun, thought it was cool. And then after a while, I kind of fell back into the space in like 2016, 2017, really realizing the value of Bitcoin, personally thinking that that was a brilliant thing. I thought that it was going to help people throughout the world, bank the unbanked, help facilitate payments where we don't have issues with governments. Also, the printing of money, this was a big thing that was happening. So I was like, okay, this is interesting. And then that kind of got me into, again, buying and selling alts again, but this time maybe with a little bit more money. And then ultimately I had an aha moment where I thought, okay, I'm making a decent amount of money on these trades for me as a young, just leaving college. And so are my friends. What are we going to do from a tax perspective? And being an accountant, a CPA, I thought, I think a lot of people are going to have this issue. This was kind of before we had guidance from the IRS in 2014, but the transaction structures, they transformed. They were much different then in 2017, 2016 than what we had from the guidance. So I figured it would be wise to start helping people figure out where they stand from a tax perspective. And that's where it started. In the first year, it was a small group of clients, friends, family, some people that met on Twitter online that trusted me, which was great. Then the next year it grew and it kept growing. And now we have a pretty decent sized firm, and we're able to bring on clients and help people all throughout the US, all throughout the world with reconciliations and tax stuff. So that's how I got into crypto, which I think is very typical for a lot of people that were into the space. They got in, they kind of fell out, they get back in, and then they really realize what's going on. And obviously we saw like a new entry into the market in 2020, right? People coming in during the COVID pandemic. And so there's like these different classes of where you entered into crypto, but ultimately at the end of the day, everyone has that same feeling. So that's how I got started. And I'm so happy that I found it at a young-ish age because, it's part of my professional life forever.
Yeah. It's really interesting too to see that, I use the word classically loosely, when we think traditional or classically trained, in that you have your CPA and you're a lawyer, you've had a lot of the traditional educational background and traditional legacy systems, and then going in and out of the crypto landscape is very interesting. So, and you start to see, and there's this, I think you're seeing this too. There's a lot of people, this mass movement of talent, right? And I think that's something important. And I know a mentor once told me back when I was in my early days of training, I think similar years, 2015, 16, was in order to be, relevant and build successful businesses, or, and I was an advisor at this point, you can't be competing on the current landscape. You got to be able to look 5 years ahead and try to anticipate, or at least try to understand what the landscape will be in 5 years. And if you can solve what those problems will be, you will be ahead of the curve and you will build successful firms, businesses, teams. And that really stuck with me. And I think hearing your story, it sounds like you saw something, that was still a few years to 5 years out, and there was going to be a need for these types of services. So you dove in. So that's a really interesting and cool story. So let's dive in a little bit more now to specifically what we're here to talk about, which is, the crypto taxes. And
Yep.
what we'd really like to start off now is just help all our listeners, which is primarily financial advisors, as well as some individual investors. What are the most important things you need to be paying attention to when it comes to your crypto taxes this year?
Yeah, no, it's a great question. And honestly, these are things that I would recommend being aware of every year. It's not just this year is a little more complicated than others. I will confess, because there's a lot of transaction structures that we've seen that are newer to the space, right? We've seen an explosion of NFTs. We've seen an explosion of all these DeFi protocols with collateralization of assets. And when I say this year, I mean the 2021 tax year that we're now looking at. We had some of this in 2020, but it really picked up in 2021. So there's things that I would mention there specifically, but overall, what people, especially new entrants into the market, need to understand is that there's a lot of misconception with the tax of these transactions. One being, which I get all the time, even from sophisticated investors, oh, I don't have to really worry about the tax consequences until I pull the fiat money out, right? Until I sell everything for US dollars and transfer it to the bank. Well, no. 2014, with that guidance, we have, and basically just tax principles. If you use a piece of property to acquire another piece of property, and there's an appreciation or depreciation in value of that underlying asset, there will be a taxable event, gain or loss there. And when we deal with crypto, which the IRS has deemed to be property, and this is a whole nother question, the SEC might deem some security, CFTC might deem some currency, who knows, we'll figure that out, but commodities. But when you're talking about IRS, property is property. I buy something, I then use that to buy something else. If it's crypto to crypto trade, that's taxable. You want to make sure, and because of that, you want to make sure that you're keeping track, you're keeping adequate records of that data. Now, if it's on a centralized exchange, you may be able to pull that ledger at the end of the year and get a reconciliation completed from all of the centralized exchanges that you've used with deposits from one exchange to another. Obviously, that's not taxable. That's like taking money from your left pocket and putting it in your right pocket. But you need those to tie out, because if they don't, you'll have a missing basis issue, which is why having the complete data set is very important. If I take my funds from Coinbase and I withdraw it and I send it to Binance US, but then I only report the Binance US history, where did the initial BTC or Ethereum buy come from? I don't know. So it'll pull up as like maybe a zero basis issue. You need to have all of the historical data in these data sets for you to be able to reconcile everything properly and have no missing transactions. Where it gets more complicated is when you have those on-chain transactions. But the good thing is those transactions are associated with like a wallet address. And if you have those wallet addresses, we can scrape that data.
Yeah, and let's pause there for a second for those listening, because maybe some people may not know the difference between what do you mean by on-chain transactions?
Perfect. So the centralized exchange transactions, not on-chain, there is a custodian of the funds. There is some exchange like Coinbase. I think everyone knows Coinbase, the publicly traded company now, where you can buy and sell in the open market. They're going to custody the funds for you if you keep it on exchange. They're going to make sure that somebody is selling, somebody is buying, there's a match, and now you purchase that asset. They keep historical records, A, because they have to, B, because they actually issue some of these transactions, some of the reports to the Department of Treasury. If they get subpoenaed, they might have to actually issue them to the IRS. That's centralized in nature. There's a third party that is controlling effectively the flow of funds between you and I, and we're doing it on a centralized exchange. An on-chain transaction, something that occurs on a non-centralized exchange, would be in, let's say, a application like Uniswap or SushiSwap, which is a decentralized exchange, where it's like more of a peer-to-peer market. There's no centralized custodian. There are people that might provide the liquidity for these assets that can be traded, and those are not Uniswap or SushiSwap. Those are individuals. Those are people that are looking to provide the assets on the exchange, to provide the liquidity, and ultimately earn a yield for doing so. On the centralized exchange, that's not what's happening. But these on-chain transactions that are occurring are going to be specifically tied to the wallet addresses that are being used to engage in that activity, whether that's buying and selling on a decentralized exchange, whether you're staking, which is going to trigger taxable events. We could talk about that in a little bit. Or if you're buying NFTs, which also are on-chain transactions, there may be somewhat of a centralized custodian-ish that you can be using, some sort of marketplace that's facilitating the transaction, but those transactions are going to be tied to that wallet, a wallet. Some people have hundreds of wallets that they use. And the reason why that's important is because you want to keep track of that data from the on-chain transactions. That is where people get into a lot of trouble when they try to figure out what their tax situation is for the year, because it can be complicated reading those transactions, pulling the data from those wallets, and facilitating a reconciliation from there. But the discrepancy between centralized and on-chain is, one, there's some third party like a Coinbase, effectively facilitating the activity, custodying the funds when they're on the exchange for you, And the off-chain, the on-chain transactions, the off of the centralized exchange stuff, you're the bank. You're controlling the funds. They're in your custody. They're your keys. They're your coins, and that's what people like about it. But there are risks associated with that. There's a lot of things that come into play when
Sure. Yeah. Well, no, I appreciate you diving into the difference there, because I think this dives into kind of one of the first things that advisors may not understand yet, and especially individual investors, that come to them looking for financial services. This is a place where you can add value, because what we do know is last year, one of the main onboarding for that onboarded crypto users was NFTs.
Yep.
So you have a lot of people who, they have a Coinbase account, they have a Gemini or a Kraken or whatever centralized exchange, but then, they got on the NFT train and they opened a MetaMask wallet and they transferred assets over to that MetaMask wallet. And a MetaMask wallet is a decentralized wallet. There is no third-party exchange. Like you mentioned, you take self-custody. And then they're going on to OpenSea or any other NFT platform and buying NFTs. Those are all transactions, and especially if you're doing large amounts, if you're going and buying a CryptoPunk for $1 million and you've transferred that from a centralized exchange, you are definitely opening yourself up to possible future. So even though today something may not happen, you open yourself up to this risk vector, if you're not keeping adequate records and quality records of everything you're doing. And this is part of the value that advisors today can help add value to clients, by asking simple questions. Do you invest in NFTs? Do you invest in crypto? How are you investing? Tell me what you're doing. So that you can help protect your clients from making better decisions. And so with what you just highlighted, I feel that already dives into maybe what a lot of advisors may not understand and how they can add value, regardless if they, help clients invest in crypto or not. But this is part of the value. And you mentioned a lot of people could fall into trouble. So have you seen this? Like, why do you say that?
So the reason why I say that is there's a lot of things that I think people can fall into trouble, specifically with NFTs. Let's focus on the NFT space because I love it.
Okay, let's do it. Yeah.
I'm sure you do too, but it's an easy way to see how some of these off of the centralized exchange, the on-chain transactions can cause issues. Number one, minting NFTs. When you mint an NFT, that's fine. That's a taxable event with let's just use Ethereum because there are a bunch of NFT markets. There's a huge market with Tezos, all the other layer 2 solutions.
Solana, yeah, a bunch of others. Yeah, let's focus on Ethereum. Yeah.
Ethereum's easy to understand because that's probably where like 95% of maybe more of the activity is. I use some of that Ethereum and I mint an NFT or multiple. Maybe I don't mint one. Maybe I mint 6 of them. There's going to be a taxable event on that because I had value, I had a cost basis in that underlying ETH, and it could have gone up or it could have gone down by the time I used it. So there's a gain or loss. That's number one. People don't think of that. Usually the minting costs are low. Lately, a lot of projects have been minting like an exorbitant amount of Ethereum. They've been doing Dutch auctions and they're raising a lot of money. So there's probably more gain or loss that you need to consider. But usually older projects like Bored Apes, people were minting those very, very, I think it was like 0.08 ETH, maybe it was less, I don't know. And the floor price was above 100, so that's a great ROI. But the thing is, that's going to trigger a taxable event. Usually there are gas fees associated with that mint, and that also can trigger some sort of tax because you're using something to get something of value, right? So there's a taxable event. The thing is, if you mint multiple NFTs and you're just going to say, and you want to attribute the basis and spread that across 6 of them, that's fine. That's easy. But when you buy on the secondary market and you buy 4 different Bored Apes and you sell one of them, in some of these reconciliation softwares, that might not populate very well because it's a different type of token, first of all. So those softwares aren't integrating well. If the client is coming to you and saying, here's my report, that's number one. Number two, they might be selling the wrong ape in that software. It might automatically pull that they sold Bored Ape 7325 when really they sold 5272. And so the reason why I'm saying this is there's a lot of manual supplementation that needs to be done to these on-chain transactions when you're pulling it in some sort of software solution. That's the first issue. So minting is not that bad, but the secondary buys and sells can be an issue. The big thing that we see is people pooling money together to buy an NFT without setting up any structure, without having any formation, without knowing what they're doing. Then they get into this issue. They bought, they sold, they swapped into like 20 different NFTs. They then sold those. Now at the end of the year, they've appreciated in value. They have all this money. They never thought of it. Oh, this is technically like a de facto partnership, but maybe we should have done something from a structuring standpoint. So we see a lot of pooled funds together without thinking through the tax ramifications of that. That's number two. But ultimately, the main thing with the NFTs specifically, but this also goes toward on-chain transactions, is what we see is people trying to do those reconciliations in-house before they reach out to a professional. And there's just a ton of zero cost basis issues. And it says that they have, $1.4 million of gain when really they had 150,000, because all of these transactions from the 1, 2, or 3 that are missing basis have gone forward, rolled forward, and now there's all of these issues in their reconciliation report. And then they reach out to the professional. Then it becomes too late. Maybe they have to go on extension when they didn't want to, and it just becomes a whole conversation. But I would say it's usually the fact that these you need to do, and a lay person can do it. You don't have to, in my opinion, you don't have to be a CPA or a tax lawyer to do this. You just need to spend the time and go through those transactions and supplement the data with what actually happened. And to be honest, the person that knows what happened is really the person who executed the transaction. They can do the best job, but oftentimes it gets very, very complicated and convoluted.
So let's pause there for a second, because there's two things I think we should spend a little time on. So the first is, if I'm an advisor listening to this, one thing I might say is like, well, my clients aren't doing that. None of my investors are doing this. What do you say to that? And what are you saying? Are investors like, how, give us some numbers, or give us some clarity on, are people actually doing this?
I don't know the specific number of US individuals that are into this space, whether DeFi or NFT, but I can tell you that 95%, maybe more, maybe 97.5% of our clients have at least one on-chain transaction for the year. And I would say half of them at least have hundreds and hundreds, and a large percentage, maybe a third or a quarter of them, have thousands. That is maybe because we're in a niche space, and so people are reaching out to tax advisors and tax professionals when they need the work, because they know their situation is fairly complicated. But I can tell you that I've had people that I haven't spoken to since high school reach out to me because they bought some meme coin. And I'm telling you, this space is huge. The NFT space is huge. The meme coin space is huge, just like the meme stock space was big at the beginning of last year. So even though you don't think there are, I'll be sitting at I'll be at the driving range at the golf course, and I'll hear people 2 stalls down talking about some token that maybe is worthless, maybe not. And these people might be sophisticated investors. Maybe they don't let their advisors know that they're doing this stuff. So I think it's good to assume nowadays that anyone that has some sort of risk appetite is actually diving into this space. Or if they're not, they want to, but they need help and they need advice as to what the proper procedure they should go through to make sure that they're not overextending themselves, or to make sure that they're doing it in a secure manner. So I would say it's definitely millions and millions and millions of people in the US. As far as the NFT space goes and the DeFi space, it's only growing for sure. And the more access people get and the easier these applications get to use, the more the user base will grow. But I would say most likely the people that are actually engaging in this activity may be people for advisors that they wouldn't have been clients, but now they're getting into the place in the space where they need this advice, they need this guidance, because they've done something for themselves to accumulate some wealth using these complicated protocols or investing in NFTs. And now they want to maybe divest a little bit of the crypto sector and move into more of risk management, be less risk on. So I don't know. That's a good question, but I think there are a lot. I think they would be surprised.
So you just highlighted why it's important to spend a little time here, because one, I'll share just some stories which I feel I got from you as well, is you can't just assume people aren't doing this, and it's better to ask. And especially as an advisor, if you have clients says they're investing in crypto, I'll just share, we've done a couple of education events with other firms, and where we have 30 to 40 clients in a room, and we're talking about Uniswap, Tezos, Polkadot, Polygon. We're talking about our portfolio, and then everyone's nodding and feeling good, and they're like, great, this sounds good. And as soon as we get to Q&A, the very first question, and I'm talking people with $10 million plus net worth, asking about NFTs. And They first ask just to say, what do you think about NFTs? Just to see our reaction, to see if we're going to be that traditional fuddy-duddy, which is going to say, oh, NFTs, they're just digital, like, they're just JPEGs, right click, save as, right? Or when you just say NFTs, why do you ask? Or NFTs, yeah, very interesting. There's a lot of use cases beyond what we see in the digital art space. And once they see we're open to having a conversation about NFTs, we've had 10 to 20, like maybe about 50% of the room, then start asking more questions, saying, you know what? I actually bought this doodle for XYZ amount, and I had no idea what I was doing, but I found it somewhere, and I just went and bought it. And now I have this large amount of money, and so I bought 3 more. And so you just start to hear these stories, and these are 60-year-olds with businesses, tech companies that have built wealth over 30 years. And you start asking them, well, how in the heck did you get involved in this? And then they start talking about, well, my kids are really into it. Some of them have kids who are 20 to 25 years old, who they're native to the space.
Yep.
And they're talking about, they have a CryptoPunk, and, you mentioned pooling funds. You got kids who, are building wallets and, just sending each other funds and pulling together without having the knowledge or wisdom to maybe think ahead and say, we have to think about maybe what we're doing. And so the way we position at these events now is to say, hey, investing in crypto is just one piece now. There are clear wealth management techniques we can employ. And the first place we go to in traditional to provide alpha is, the tax alpha. And so it's ripe, especially in this space. So I thought that was important, maybe to highlight. And then I guess the second thing too, regarding, kind of what to start thinking about, is you can't just dismiss what's happening and the growth that you're seeing within the space. And it's actually going to be imperative for you. You actually have an opportunity to gain a new client base. And we've been preaching it from the rooftops that if you do this, you actually will gain access to these millionaires. And I'm not talking 1, 2, 3. I'm talking 5, 10, upwards of 20. Obviously, the farther up you go, the more scarce they are. But you're going to open yourself up to being able to add value to these investors who now, they're like me, maybe in high 20s, early 20s. They want to live a great life. They want to be able to do things more than what they're doing. They need wealth management. So if you just, dismiss it, you're closing yourself up to the real business opportunity. And so can you just talk a little bit more and expand upon the business opportunity that you're seeing and, the types of demographics of clients you're seeing?
I would actually, yes, definitely. I would 100% echo what you just said, because if somebody's going to take that approach where they're kind of dismissing this space, I promise you, those people that would have and should be clients will not want to work with somebody like that, because they are very in tune with the space. They really believe in what's happening. They've generated a lot of, let's say, wealth here, and they want to be allocated there, but they want to converse with people that speak that language. And it's not like, okay, you can't be a part of this club. No, crypto and NFT, like the Web3 space, is very, very open. It's an open environment. If you're willing to learn, if you're willing to participate, everyone will accept you, and you can learn very quickly. But these people, just like you said, millions and millions of dollars of wealth being generated over the last, let's say, 1 to 5 years for some of these people that hadn't seen that money before. They do need help, and they do need advice, but they want to make sure that they don't have to be necessarily crypto native, but they want to make sure that people understand the space, are willing to work with people in the space, and appreciate what's happened over the last 3 to 5 years with the amount of growth that we've seen. In terms of demographic, I mean, to be honest, it's it varies. We have clients in their 50s, 60s, 70 years old that sold a large portion of their real estate portfolio and immediately dumped that into Bitcoin, started earning yield on that, and then moved from Bitcoin to Ethereum and started LPing on Uniswap, and then moved from there to buying NFTs. And
time out. You just said LPing. What's LPing?
So going back to what we talked about earlier with, let's say, like the Uniswap or SushiSwap example, there needs to be a liquidity pool on these decentralized exchanges for people to buy and sell. So if I were to provide liquidity for, I'm going to make up a token, XYZ token, and there was a base pair XYZ and Ethereum, I would provide liquidity, right, to the pool. 50% of that would be in XYZ coin, 50% of that would be in Ethereum. And now people can start buying and selling effectively. And there's a lot of people doing this. And when I'm doing that, when there are transactions occurring, I earn a fee. I earn a little bit of a reward for doing that, which is why they're taking out the centralized exchange, right? That's what this DEX is, this decentralized exchange. So they're doing that, and they're going from the traditional world of, I'm going to, slowly appreciate wealth with real estate. I'm going to buy, I'm effectively, buying depreciation. I'm getting tax benefits. I'm going to dispose of this asset, but I don't want it to be sitting in cash. I'm going to buy some Bitcoin. It was well timed, but then they started getting heavily involved. I've seen that with like 60, 70-year-old people. And I've also seen 20-year-old kids just out of college, 22-year-old kids just out of college that 100x their portfolio and are sitting on $2, $3, $4 million, and they don't know what to do with it because they never thought they would be in that position. So it really honestly does scale across all demographics, all kinds of people, all places in the United States and abroad. There's so much wealth being created. And they're, just like you said, traditional investors that wanted exposure and saw like their children were getting involved, and they're like, hey, there's an investment opportunity here. Or people that just got in early, they had one big allocation to an asset, it hit, and then from there slowly built. They went from like $10,000 of whatever to like $100,000. They had a 10x in 2018. They preserved that wealth. They stayed alive. And then 2019, they did a little bit okay, whatever. 2020 was really taking off. And then last year, they had another 10, 20, 30x from there. And it happens. It happens in this space. And those people are looking for guidance. They are looking for help, but they want to make sure that the individuals they're talking to appreciate the space and don't just dismiss it and say, that's a scam, or, oh yeah, Bitcoin's going to zero. I think we're past that now. Or, oh, NFTs are worthless. They're just a worthless JPEG, like you said, right click save. But it's not. It's community, it's culture. Of course, there are projects that people get involved in that rug. They go to being worth zero, or they don't deliver on what you thought. But there's so much opportunity for advisors to seek out these individuals. But really, these individuals are seeking out advisors. They just want someone to know what they're talking about, to understand what they've done, and appreciate the fact that they want to continue to do that, but also want to allocate in other places.
Yeah.
That's what I see.
Great. I appreciate you going into that. I didn't mean to go on that side to take away from the tax conversation, but we have an audience who I think are really on the cusp, on the threshold of, really, do I dive in or do I stay on the sidelines? And these are important pieces to understand about the demographics, the investor base, really what the business opportunity is. So that wasn't even planned. So there you go. So let's dive back into the tax specific conversation. I think one area we get a lot of questions on specifically, and I know there was a recent case where a couple investors put out some litigation against the IRS on staking. So tell us a little bit, what are maybe some one or two takeaways from staking? What would you tell investors or firms working with clients?
Got it. So you're referring to the case, it's the Jarretts are suing, and it's Tezos related. They had some Tezos rewards. They paid the tax. They wanted a refund. They effectively want to say that they shouldn't have had to pay the tax because staking rewards shouldn't be taxed at the time that they receive. There should be taxed at the time that they're disposed of. Using an analogy to, like, if I plant a tree, apples fall, I then go and sell that at the market. I don't get taxed when I get the yield of something growing. I get taxed when I sell it, right? That's their example. In this situation, I personally don't think it's a winning argument, and we can have that discussion a little later. But the thing is, nothing has changed. There's been some, literature, there's been some posts and some blog posts and some articles about how the IRS wanted to issue a refund. Staking rewards are no longer taxed at the time they're received. That's not what happened. Effectively, the IRS does this all the time where they'll try to, just settle out of court and say, yes, here's your refund. But that doesn't, there's no precedent there. There's no case law. There wasn't a case. The taxpayers didn't want that. They refused that. And now they're trying to seek to set precedent.
Establish that precedent, yeah.
Right? Which is great. We need this sort of answer. But ultimately, at the end of the day, staking rewards, in my opinion, and I think what's going to happen, it's income upon receipt when the reward is generated.
So let's pause there and repeat that, because I think there's been a lot of it, and I'm really happy you mentioned that, because there have actually been a lot of misrepresentation, a lot of misreporting. And I'm talking from the main source. I'm talking, you saw Blockworks, CoinDesk, IRS sets precedent for staking returns not being taxed. And one of the first things I said, because I was paying attention to that case very closely, because yes, that would be amazing if that were the case. But nothing actually changed. And I saw people all over LinkedIn saying, oh, staking rewards no longer taxed under IRS rules and regulations. And I told everybody, no, that is not the case. They just gave them the refund.
Right.
They did not anywhere say that we are not going to be taxed. There's nothing in there. So just repeat that for the listeners. If a client comes to you and says that, what was the actual resolution to the case?
The resolution was there was no resolution, because the IRS offered the refund, which doesn't do, there's refunds that are offered for many things. It doesn't do anything in terms of guidance, revenue rulings or regulations, treasury regulations, or tax code changes, which wouldn't be something that would happen that way. It would be more like maybe a private letter ruling. I don't even know what would have happened, but that didn't do anything. All that it did was set the foundation for the Jarretts to then try to set precedent by filing a lawsuit in court. This was something that was, I don't even know why it was reported in that manner, to be honest. I think it was not the smartest thing to do, because it was very confusing. We had people calling the office asking if they could amend returns from like 2 years ago, and I was like, nothing happened. But the key that you need to understand, or that everyone needs to understand, is that nothing has changed. There's no change in anything related to staking rewards. We still don't have guidance specific to staking, and we still don't have any sort of, FAQ, I believe, from the IRS specific to staking. All that we know is that the asset that you're generating is a yield of some sort. It's income of some sort. Now, there could be arguments of how you want to classify that income, but this case, which wasn't a case at all, it was just the IRS trying to settle out of court, didn't do anything other than lay the foundation for this to proceed and go forward, which maybe the tax courts or maybe the court system will allow for some sort of precedent to be set. But again, I doubt that would be the case. And as of now, the way that things need to be prepared and need to be reported from a tax perspective, in my opinion, and I think it's industry consensus, is that these staking rewards are taxable at the time that they are received. Staking as a process is a little complicated, right? Maybe somebody's running their own node, maybe someone's using like a staking service, but still you're getting paid a reward for doing so. And that's pretty much income 101. Like that's taxable income.
Okay. Thank you for repeating. Thank you for reviewing that. Really important to get on this episode. And I guess just for anyone listening to, let's do a quick definition. I'll go through a couple of things, and then please, Jordan, jump in with your expertise on this. Just for those asking yourself, what is staking? Staking is done through networks and blockchains that use a consensus mechanism, basically the mechanism at which they get consensus on the network, right? So Bitcoin is proof of work, right? And so we won't go into what proof of work is, because I'll assume that everyone has kind of heard about the energy consumptions and the cryptography associated with that. So proof of stake is different in the sense that proof of stake is basically operated to when you're securing or running nodes or validating transactions on the network, you do that and you are rewarded based on how much you stake. So staking basically just means you lock that native asset into the network's protocol to basically go to work. So your staked assets and the node is actually doing work. And to get paid for that work is what's called staking rewards. So you get a reward for staking and locking that asset into the network to help secure it and help do work on the network. So Ethereum, for example, is in the process of transitioning from proof of work to a proof of stake blockchain. So what we are seeing here are a lot of investors have actually locked up their Ethereum to what they call the ETH2 blockchain to pre-stake on what's coming in Ethereum to earn this staking yield. So a lot of clients, and you can actually do this through Coinbase. So a lot of clients do have an easy on-ramp to doing this, which is why it's important to understand what staking is. And it will come up more and more as proof of stake blockchains like Tezos and Ethereum moves to it, and other proof of stake blockchains become more prominent and get more adoption. So did I cover proof of stake? Would you add anything to that, Jordan?
I actually think that was a very, very good high-level overview of proof of stake and what's happening. I wouldn't add anything in terms of how that flows. That's exactly what happens, and that's exactly why people get paid a reward, is because they're effectively helping facilitate that network activity. And it only makes sense that they generate some sort of yield from that, some sort of reward, which is why when you explain that very well, you can see how that payment that they're getting is income. They're providing a service effectively, and they're getting paid and compensated for that. I see the argument. I understand the argument when there's specific sorts of staking rewards that are generated. It's like you're generating the asset, you're creating the asset, but I don't really follow that school of thought. So yeah, it's very important for people to understand that that is taxable. Maybe people want to treat it as a different classification of income, right? Treat it as, I've seen people make the argument, and I think there's a viable argument to say this is like a passive activity. This is a passive like rental / royalty income, because that's kind of what you're doing. You're kind of renting your tokens to the network. You can pull them. And if you have a client that has, and again, not saying this is tax advice per se, but I've seen this and I've discussed this many times. If you have a client that has a lot of real estate, but they're not a real estate professional, and they have a lot of passive activity losses, and you have this passive activity that you're generating income, maybe they can offset. I've seen that, but I think traditionally people treat it as like other portfolio income staking rewards.
Yeah. Well, again, really appreciate you diving into those aspects because I think it's important. I think a lot of advisors listening and anyone in the audience who's doing a lot more activity, these are the important pieces to understand as you dive further into the crypto landscape. It's not just, buy and sell an asset, number go up. There are many more things happening. And so especially from a tax perspective, we at Arbor Digital, we only see the tax situations for clients only becoming more complex. So having a service or an offer to be able to add value to client situations is imperative. And that's one of the things we espouse to our clients or our prospects when they're looking at us and our SMA offer, that you don't just get an SMA in a portfolio, is you get access to professionals such as yourself and firms such as yourself who provide these services beyond just buying and selling and investing, which is going to lead to more generation of client revenue, trust, build relationships with the next generation investor. So if you're listening to this, know that there's much more happening, and taxes are a huge part. And Jordan, I want to kind of dive into the last piece of this episode, just to help advisors maybe make some more real connection and maybe share a story of a client maybe you've worked with. You don't have to share any details you don't want, but maybe share a time that a client came to you and you added value through their situation.
Yeah, well, I'd like to think that happens every day, but
of course it does.
Yeah, of course, right? No, I think because this stuff is more recent in memory, like 2017, 2018, I can tell you for sure, this doesn't happen as much anymore, but people were trading on exchanges that maybe they shouldn't have been, or they don't have access to anymore by the time we're doing the reconciliation, or they were on an exchange that was, then defunct and they couldn't get the historical data. We did a lot of these sort of which I don't think many people did because it was kind of a complicated process. But we did a lot of imputed transactions to kind of trace what the activity would have been, because the historical records are lost, to obviously report in good faith what the activity looked like. Because had we not, there would be these issues I was mentioning earlier, a lot of these zero basis transactions. And obviously the person paid for their Bitcoin or their Ethereum or whatever altcoin they purchased back then. They obviously paid something for it. Even if they were gifted it, there was some basis. So to have a zero basis transaction didn't make sense. We went back and we would go in and create these external reconciliations with imputed transactions to attribute basis to some of these transactions that should have. It was very detailed, but sometimes people would show, $500,000 gain on the year or $750,000 gain on the year, when in actuality, when we bring that down, it was like 63,000 or like 73,000. So it's a huge difference, because when volume builds on top of each other and there's no basis to attribute, it's like a cascading event. It's terrible. So that was stuff that we used to do early on. Nowadays, the complicated activity that we see mostly resolves around borrowing and lending on chain. So people that are collateralizing their assets on chain, they're borrowing against it. They're then using that, and this is going to talk about something we haven't talked about, but then they're bridging those tokens, which is effectively moving from like one blockchain to another, right? They could take from Ethereum and bridge their tokens to something else like Luna or Avalanche, a different ecosystem.
And for real quick, so for those listening, you may go to an exchange like Coinbase or Gemini, you may see an asset with a little W next to ETH. That stands for wrapped ETH. And those are some of those assets that get created to bridge those exchanges. So just a quick highlight there.
Exactly.
Because I've gotten questions from advisors. What's a WETH? I keep seeing that. And so, but anyway, so bridging, that's where that goes into.
It's a great point. It's a great point, because people do get confused about that when they're only trading on centralized exchanges. Like, what is this? But yes, so they'll bridge their assets. Then they'll be playing in these different ecosystems that don't integrate into any tax software that they're trying to use. So the real value add now for, I would say, the last, let's say, 150 clients that we onboarded is when they do that, because they're all doing that, making sure that we can reconcile that activity. We do it offline. We do it in internal work papers, because it kind of has to be done that way. Making sure that they can reconcile that activity, so they're getting credit for the basis of the loan. Obviously, it's not income, and they get cost basis in that. They get, they're treating the loan proceeds the right way. They're treating the repayment the right way. They're treating the bridging of the asset to a different blockchain the right way. It's all getting captured, because sometimes we'll see people that they did a report. They try to use one of these internal, these software solutions, which are great, by the way. I advise one. I would highly recommend people to go check it out. Coin Ledger, it's cryptotrader.tax, great software. But there's issues. It's showing, the people come to me and they say, this is telling me I had $3.7 million of gain. I know for a fact I didn't. I actually operated at a loss this year. That happens. Not so much in 2021, but that happens. So we tinker with the data, we supplement the data, and we'll bring that down to the true number. Because if they don't do that, they'll get into the issue of not reporting. They'll say, this told me I have $3.7 million of gain. I lost money. I'm just not going to file any return with crypto on it. And that is where people get into trouble. So I'd like to think that that's probably the biggest sort of saving grace that we can do, is make the data look like what actually transpired, and then have them and facilitate the reporting of that on a tax return. Because when people don't report anything on the returns, and then they get these form letters from the IRS, and then they have to call the lawyers and the accountants and do this, it just becomes an issue. So we try to preempt that. So I would like to think that that's probably the biggest thing that we see. And it could be, $10,000 saving, it could be $100,000, it could be $2 million savings, but it's material to that individual no matter what. And ultimately, that's the goal of being able to provide this sort of advice and this niche market, that not many people have the understanding of what's going on with the on-chain transactions. So I'd like to think that's probably the biggest sort of story that we've seen over the last 18 months. It's always related to that, always.
Wonderful. I know I'm listening to this story and I'm thinking back to client conversations and thinking of what questions I can ask, in my advisory meetings or my financial planning meetings that I'm doing with clients who I know are investing in crypto. I think I'm already even thinking myself, man, I got to start diving a little deeper just to make sure I'm protecting my clients. So if you're listening to this right now and you're thinking the same thing, I'd like to kind of end this off by doing a quick summary. Jordan, thank you so much for joining today. We talked a little bit about what the current landscape is, since 2014, where we have guidance. We talked a little bit about kind of the pitfalls or the mistakes that we're seeing investors make, and where you can come in and add value to make sure they're not falling into them and actually experiencing these pitfalls. And then, just hearing your stories and, talking a little bit more about the staking, because that's been a big question. And specifically with NFTs, I know even though a lot of advisors think, oh, my clients don't do that, I can assure you most of them are. So we did a lot this episode. And again, Jordan, thank you so much for coming on and sharing all of your expertise. But I know now if I'm in the position that I was in after we did our initial talk, I'm like, okay, I'm going to need this at some point. Jordan, how do people get in touch with you? Where do they get in touch with you? Let people know.
Yeah, of course. Twitter is really great in terms of connecting. I've connected with a lot of people on Twitter at Taxing Crypto for the CPA firm. Law firm's not as active at Bass Law, but it's fine. But in terms of connecting, scheduling calls, or if anyone needs to talk to me, there's ways to do that on the website. On the CPA firm, it's taxingcryptocurrency.com. The law firm, same thing. Actually, it's a little different, basslaw.io. We're a little bit more in tune with the space when the law firm started. And I think that that's the easiest way. We're kind of working, me personally, on like a strict calendar basis, but I like to talk to people, try to hear their stories, see if I can provide any sort of guidance or expertise. So I would say that's probably the easiest way to reach me. I am on Discord too. If any people are degenerate enough to be on Discord, they can reach out to me there. Taxing Crypto, same thing. But obviously you need a little bit more information to add a friend there. And that's pretty much it. Social media a little bit. Crypto Twitter is very, very explosive. I'm sure that and I'm sure that people that are listening that are involved know. But traditional forms, unfortunately, of email, calendar, Calendly, all that stuff for the law firm and the CPA firm.
Wonderful. So please, this is an added benefit we're hoping to bring to all advisors across the country. If you have any questions about what we do at Arbor Digital and how we add value through our SMA and our portfolio offerings and everything beyond, education services, tax and legacy planning services, and getting access to professionals and firms like Jordan, we have a robust network that we are developing to add continuous value, so that way you can continue to do what's important for your clients and spend the time with them, as opposed to having to do all this 24/7, 365, diving into this space. Jordan, again, thank you. And yeah, we're going to have to connect on Discord. I tend to identify a little bit with the DGen activities. So we'll definitely,
I know you do.
We'll definitely have to connect there a little bit. But everyone, again, be safe. If you know anyone that's directly or indirectly affected with what's going on in the world right now, please send your energy, do anything you can for them. We know we are. And thank you for joining us on today's episode. Please give us a like and a share, and reach out to us anytime. Tell somebody you care about them, and we'll see you next time on Asset Revolution. We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
We are financial advisors. However, we are not your financial advisor. Unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.